That number on your 401k statement, it's not your retirement. It's a starting point for a calculation most people never finish. According to Vanguard's How America Saves 2026 report, based on 4.6 million participant accounts, the average 401k balance at the end of 2025 was $167,970. The median was $44,115. That gap alone tells you something important. A small number of very large accounts are pulling the average way above what a typical saver actually holds. If you've been benchmarking yourself against $167,970, you've been measuring yourself against someone in the top quarter of all participants. But that's not even the number I want to talk about today, because neither figure tells you what your account is actually worth in retirement income. And that's a very different calculation. Let's build it from the ground up. Marcus is 35. He's been contributing consistently to his company's 401k for 8 years. His balance right now sits at $94,300. On paper, he's ahead of the median for his age group, which Vanguard puts at $39,958 for the 35 to 44 bracket. Marcus feels good about this. His quarterly statement shows a positive number, it's going up, and his HR department told him he's on track. Here's what none of those things told him. First number nobody talks about, the fee drag underneath his balance. Marcus's 401k holds a target date fund with an expense ratio of 0.68%. That sounds almost negligible, but a June 2025 Abernathy daily analysis of 58,300 corporate 401k plans found that more than 99% of them contained at least one fund with a cheaper, higher performing alternative already available in the plan lineup. Marcus didn't pick the more expensive fund on purpose. It was the default. According to the 2025 Investment Company Institute study, the average expense ratio for 401k equity mutual funds is 0.26%. Marcus is paying 0.42 percentage points above that benchmark without knowing it. On his $94,300 balance, growing over 25 more years at 7% annual returns with $10,000 in annual contributions, a 1% total fee difference compounds to a $469,000 gap by retirement. Not a rounding error. That's what the Department of Labor's own fee publication warns participants about, in documents that only about 25% of plan participants actually read, according to recent data. Second number nobody talks about, the tax bracket you'll be in when you withdraw. Marcus has a traditional 401k. Every dollar going in is pre-tax, which feels like a win, and it is, right now. But at retirement, every dollar coming out is taxed as ordinary income. The federal tax treatment of traditional 401k withdrawals, per IRS rules, means that Marcus is essentially deferring a tax bill, not eliminating it. If he retires with $900,000 and follows the standard 4% withdrawal rule, that's $36,000 in taxable income per year from his 401k alone, before Social Security, which Vanguard estimates the average beneficiary will receive around $1,900 per month in 2026, or roughly $22,800 annually. Add those together, and Marcus is looking at roughly $58,800 in gross income. Depending on his state and filing status, he's paying real taxes on that. The number on his statement today doesn't reflect that haircut. Third number, required minimum distributions. Starting at age 73, under current IRS rules established by the Secure 2.0 Act, Marcus must begin withdrawing a calculated minimum from his traditional 401k every year, whether he needs the money or not. If his balance has grown to $1.1 million by then, which is achievable, his first RMD is roughly $42,500, calculated by dividing the balance by the IRS life expectancy factor of 26.5 for a 73-year-old. That's income he may not have planned for, potentially bumping him into a higher bracket right when he thought he was done making financial decisions. Let's keep this fair. None of this means the 401k is a trap. Feelings and math are two very different things, and the math on a well-managed 401k is still very good. The contribution limit is now $24,500 in 2026 per the IRS, up from $23,500 last year. If you're 50 or older, you can add $8,000 more. Ages 60 to 63 get a super catch-up of $11,250. The tax deferral is real. The employer matches free money. And Fidelity's Q1 2026 data across 25.6 million participants shows total savings rates hitting a record 14.4%. People are doing the right things. The issue isn't the vehicle. The issue is reading only the odometer and never checking the fuel costs. Here's what's more useful than a subscribe button. Right now, before you close this video, there are 3 numbers to pull up in your plan portal. This takes under 10 minutes. 1. Your total expense ratio. Add up the expense ratios of every fund you hold. If the weighted average exceeds 0.50%, you likely have cheaper alternatives already in your plan lineup. The benchmark for index funds in 2026, per Vanguard's own February 2026 data, is 0.06%. 2. Your Roth versus traditional split. If you're in a lower tax bracket now than you expect to be in retirement, or if your employer offers a Roth 401k option, the math on paying taxes now instead of later frequently changes the outcome over 20 plus years. Run both projections side by side using your plan's calculator, not just the default projection. 3. Your projected monthly income, not your projected balance. Most plan portals now show this. If yours doesn't, take your projected balance, multiply by 0.04, and divide by 12. That's your estimated monthly draw at a 4% withdrawal rate. Then subtract your estimated tax rate. Compare what's left to what you spent today. The number on your statement is real. It's just not the whole answer, and nobody wins financially by knowing half of it.